Hi, welcome to the second edition of the Horizon Videozine. This is Rahul Sharma here from GM Financial, bringing you the macro technical outlook for the markets. Now, sell in May and go away was one old adage which worked beautifully in the markets, but not in 2023. We've seen FIIs buying for like 4 consecutive months now in the cash segment, and May being actually a bumper number for the cash segment in the equities. Now, what does that translate? That translated into 4 months of underperformance which we were entering into. That got reversed, and finally we have a bull market hitting new lifetime highs for the Sensex and the Nifty. So one thing that has clearly stood out in this entire up move is this rally has been backed by buying in the broader market. We've seen Nifty 500 index leading the rally. We've seen small caps doing extremely well. We're seeing mid caps also having a party. So when you have the entire broader market participating in a move where the Nifty and the Sensex have hit new life highs, it only adds to the party. On the derivative side, one interesting thing is institutions so far haven't had a strong directional stance on the index derivatives. Now, there was a point in time where FIs were aggressively bearish. There was a point in time where DIs, retail, were aggressively long. But this time around, the aggression in terms of institutional participation has not sprouted up. So, friends, looking at a layer below the market, which are the indices which have done extremely well? So, if I dig deeper, there are 3 indices which stand head and shoulders above the entire broader market. So one is the Nifty Auto Index. Nifty Auto Index has had the time of its life, and in fact, if we do a simple calculation of the returns generated from December, where we started the cooling off or the so-called correction, till date, the auto index has done the best performance, has given the best performance on the upside. Now this is followed by the reality index. This is followed by the mid and small cap indices. So these are the pockets of the market which have done extremely well in a period which saw both a correction as well as a bull run. Now there is one segment of the market which has been a gross underperformer. So this is the IT index. So IT index has been under pressure due to what is happening in the US. But finally, there are some green shoots happening after Fed gave the clarity on what would be their strategy for the rest of 2023. So coming to the global participation or the relative performance that India has shown in the recent past. So there was a point in time where India was underperforming the US markets. Now we've clearly started outperforming the US market. So if we simply do a price comparison between the Nifty 500 or the Nifty 50 index vis-a-vis the S&P 500 or the Dow Jones index, clearly the gap between Dow Jones and Nifty is quite large. If you are a trader or an investor, what should be the key level to keep an eye on? So as we've moved up, as we've seen this rally, markets have maybe consolidated for a few days and then just kept on going. The bull run has been relentless. Now, yes, it will not be a straight line. We are headed northwards, but profit booking once in a while or a bit of correction once in a while will always be welcome. So speaking of levels on the macro technical front, eventually 21,000 may be tested by the end of this year. So if you are into equities, if your asset allocation on the equities is lacking, this is the time to top up. Now be specific, do not top up in small caps and mid caps because these are the indices which are at their life highs. They've done fairly well in this up move. Look at the pockets of the markets which have not performed well. So one is metals. Metals is a cyclical play. They have still not delivered the kind of returns that they are capable of. Second is the PSU banking space. So PSU banks have broadly underperformed the banking basket, and we feel that PSU banks, the risk reward is pretty attractive if you are an investor. And then comes the IT space, which we just spoke of. So be selective should be your strategy when it comes to making a tactical shift in your portfolio, and do remember to book profits in the sectors that have done extremely well. Now coming to the PSU bank story. So it has been like at the time of recording of this video, PSU banks have been consolidating for a good 8.5 weeks. So our sense is this underperformance should get reversed into a brilliant breakout on the charts, which could mean an upside of around 10 to 15% on the PSU bank index, and probably even bigger return on the individual stock components. So PSU banks are the ones to go for. The top names technically are Bank of Baroda, followed by Canara Bank, followed by State Bank of India. These are the names which we feel there is a good bit of upside that can be had going into the next few weeks. Coming to the metal index, this has been a very, very volatile play. Now with good things, or at least positive things coming in from the China side, they recently had a rate cut. I think eventually metals will do well for the rest of this year, and metal index is poised for like a 10 to 12% return in the very short to medium term, and probably a 20% return by the end of this year, which could mean the likes of Tata Steel, the likes of Hindalco, the likes of Steel Authority of India should do well and generate wealth for investors. On the hottest sector which has been this year in terms of a decadal breakout is the PSE Index, or the public sector enterprise. So we feel the breakout has just begun. We were very early in the industry to spot this breakout. It happened somewhere in January, February this year. This breakout has continued, and we feel there is at least another 18 months of bull run that can be had in this sector. So in case you do have PSE stocks in your portfolio, hold them tight. Even if you don't have them, we recommend getting onto this train and making the most of this bull run, which is right ahead of us. Right, and like I said, areas of the markets which are too hot, mid and small caps. Look at reality. Look at some of the names where the index has gone up like 20-30%. These are the areas where one should look to book profits. So to sum it up, it has been a good quarter for the markets. It has been a good quarter for India incorporation. And eventually we feel that with the onset of the monsoons, they are a bit delayed for sure, but the markets will be closely tracking that, and inflation domestically hasn't been a big concern for us as it has been for the West. So we feel that the bull run is still on, and stay invested, stay bullish is the mantra. Traders would be delighted to know the kind of derivatives market that exists in our country. Thanks to NSE and BSE, we literally have an F&O expiry happening almost every day of the week. Example, Tuesdays we have the FID Nifty expiry. On Wednesdays we have the Nifty mid-cap expiry. On Thursdays we have the Nifty and Bank Nifty expiry. On Fridays we have the expiry for the BSE derivatives, which is Sensex and BankX. So courtesy market volatility and the kind of retail participation that we have, we are happy to report that our derivatives team has done extremely well in delivering value to our customers. So derivatives is not only vibrant, but at the same time, if done with proper guidance, has delivered fantastic outcome for our clients. So profitable clients are happy clients, and we are happy to report that. So thanks for listening to this version of Horizon Videozine. I hope this was helpful to you, and have a good investing time ahead. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.